Well, if you're looking to improve your path to prosperity, you've come to the right show. Welcome to the Master of Money. Tonight, we're going to be talking about how to mitigate the risk in your portfolio, so you don't want to miss this presentation of the Master of Money. Hello, everyone, and welcome back to the Master of Money program. I'm Steve Beeman, your host. And whether you're joining us live in the studio audience tonight for the meetup meeting, or you're joining us through the Ustream videos around the country and around the world, we're glad that you're with us. We've got a great program tonight. I was able to get our friend Tim Newell to join us in the studio tonight. So the second half of the program is first going to have Tim, and that's important, but it's going to be extended. This may be a little longer program than usual because Tim has a lot to say and you need to hear it. So as we begin looking last week, we talked about risk. And if you recall, we talked about the difference in measuring risk between you and our friends on Wall Street. Well, Tim's program and Tim's segment tonight is going to address that even more. I want to move very quickly so that we shorten up the time on this front end. But the question we got last week that I wanted to address came in from a viewer who asked very specifically, how likely is it that interest rates are going to be raised here in the near term? Well, last week we had a new jobs report, and as you saw, the U.S. economy strongly pumped along with 255,000 new jobs. That's a very good report, but more importantly within that report, wages have begun to come up. And that's important because that's the trigger the Federal Reserve has been looking for as they look to raise interest rates. So I think we can look at this jobs report as the beginning of a thorough analysis by Janet Yellen and the Federal Reserve to begin thinking of moving up those rates. You can't predict the future, but I would look to the second quarter to see those rates go up. So that's, again, directly related to tonight's second half of the program. So make sure you stay around for my time with Tim Newell. We're going to talk about investments, target date funds, and other things specifically affected by rising interest rates. Now, in the geopolitical world, there's so much to talk about here. We could go on all night, but we're short on time, so I'm going to summarize it as this. Europe is in chaos. The Ukrainian situation has gotten much worse. In fact, Angela Merkel, the Chancellor of Germany, was in Washington this week and is headed straight from there to Moscow to meet with Mr. Putin. The reason? Russia and the Ukraine are getting hotter and hotter by the day. We could see a hot war there anytime because the Russians want the Ukraine back. And the Ukrainians don't want to go back to Russia. Very tough situation. NATO is involved, although the Ukraine is not a NATO member. NATO is watching this very, very closely. So the Ukrainian situation has Europe in more of turmoil than it's been. We've talked about Greece and the Syriza group that's come into power that's negating the European debt. We've talked about Switzerland taking its currency off the euro. We now look at France, who is suggesting through their parliament that they have closer ties to Russia than they do the United States. These are scary thoughts, but they're tumultuous times coming in Europe. All the more reason you need to have sound risk management on your portfolio. But around the world, in addition to that, we've got ISIS that continues to cause problems in the Middle East. Many of you saw that horrific video last week of them burning a Syrian pilot alive. These people are dangerous to the Middle East, and the United States, together with not just our NATO partners, but Russia as well, Syria, and all other nations need to be addressing this ISIS conflict before it starts to cause real havoc in the Mideast. Now, again, we've touched on the January jobs report, and I'm moving rapidly tonight because I'm anxious to get to this second segment. And again, it's going to run a little longer, so stay tuned. But we saw oil prices rising a little bit last week. This is a bit of a break in the trend. Now, it's not systematic as much as it's just a trading move, but it shows that the U.S. economy is very subject to that. The markets responded positively to it because the energy sector is such a big sector. But there's more information coming out this week that oil really is going to stay in those lower price ranges for the indefinite future, perhaps out to 2020 or so. And that's just because there's such a huge supply of oil in the world. So we had the jobs report, we've got the oil situation going on, and I thought this was kind of interesting. You and I have talked about unemployment and what it really means. Do we have 5.6% unemployment? Do we have 11%? What's the real number? Well, the chief executive of the Gallup organization, and many of you know Gallup surveys, the chief executive of the Gallup organization came out last week and blasted Washington for its abuse of the polling system. His comment is that the U.S. is nowhere near 5.6% unemployment, and everybody knows it. The real number is more like 11%. And the reason for that is that the 5.6 number fails to recognize as unemployed people who have fallen off the unemployment rolls, in other words, the most chronically unemployed. It fails to understand significant underemployment. Let's take, for example, an electrical engineer from Motorola who's laid off and now works 20 hours a week at McDonald's. Well, for you and me, we would consider that severe underemployment, if not unemployment in and of itself. Well, the 5.6 number doesn't count any of that. So the Gallup organization came out with a truly scathing report and said that the U.S. government needs to begin to be more honest with its unemployment numbers, and that number is more like 11%. Now, you and I have talked about the barbell economy. We've talked about how as we go forward with technology, with globalization, with other strategies and strategic changes, the economy itself is changing. We can't always look to the past to find the new norms. Well, I think this 11% unemployment, that's a real number, is part of what may become a new norm. But as long as productivity is high enough in the working people, well, that will cover that without too much disruption to the economy, believe it or not. So I thought Gallup's comments were interesting. I thought you should know about them. The major markets last week reversed their slide on the good jobs report. The Dow was up 3.5%. The S&P was up 3%, and so was the NASDAQ. Clearly, the markets like that sign of a stronger economy. But let me point this out. Jobs reports are a lagging indicator, meaning that they're following a trend that's already established. We're looking here more for leading indicators like inventory buildups, business production numbers, things like that, and those numbers aren't quite so rosy. That's why you've got this market being skittish. Jeff Garbaz, who joined us last week in Superstock, in that portion of the show talked specifically about his opinion that volatility is here with us to stay. Now, that volatility can be profitable for you. It can also hurt you if you don't know how to manage your risk. And that's why we're going to come back in the second half and talk to Tim Newell. Now, before I take you into our quick break, I did want to mention something kind of funny to you. There's a process on the internet or a social media site called GoFundMe. And it's where people put up charitable requests. Somebody maybe needs brain surgery and they can't afford it. So they'll put up a GoFundMe request for brain surgery. Well, for most of these, you and I can look at it and say, you know, that's reasonable. It's a charitable exercise, and maybe I'll give of some of my earnings to support that. Well, last week there was a new GoFundMe request, and it was by a woman in Arizona who moved there with her husband, and the poor dear, her swimming pool is broken. She needs to raise $50,000 to fix her swimming pool. She's asked all of us to share our wealth for this. So perhaps if you're feeling extraordinarily generous tonight, you'll share some money with that poor dear down in Arizona who feels entitled to have her pool fixed. I'm not sure I agree with that, but that shows you perhaps the state of where we're headed. So I know, again, we've cut this first half short. We're going to jump right into the second half when we come back. And as I said, Tim Newell from Harvest Investment Services is going to join us. And Tim's got some fabulous ideas for you that follow on last week's. How do you define risk? How do you measure it? And how do you make money on it? So we'll be right back, folks. Stay tuned for the second half of The Master of Money.
It's only a car. A car is a car is a car. With nuts and bolts and leather and cogs and steel and wood and glass, intelligent wipers and head-up displays, alloy and oil, sensors and sound, digital mapping and satellite tracking, twists and turns and smiles and miles. infrared eyes, and self-drying brakes, and one little key. A car. It's only a car.
Welcome back to the program, everyone. We're so pleased that you've chosen to join us tonight. As I mentioned earlier in the program, we are thrilled to have Tim Newell with us tonight. Tim is the principal at Harvest Investment Services, where, not being facetious, they harvest gains and they minimize losses, and that's why we've got Tim here tonight. We're going to follow up on last week's presentation about the different definitions used by Wall Street academics and you when it comes to risk. Tim, thank you for joining us tonight.
Thank you for having me, Steve.
Now, last week we were talking to our Master Money participants about the notions of risk and what that means, and the fact that Wall Street likes to put fancy words around this stuff, but to most of your clients, risk is as simple as, did I lose money?
Absolutely.
What are your thoughts about that?
Well, first of all, Steve, let me just say that last week you did a fantastic job.
Thank you.
On the topics that you were attempting to cover, and even incredible that you were able to make it so clear without having some of the graphics that we use in PowerPoints and slides and things like that all the time. If you don't mind, what I'd like to do today is maybe give the audience some slides that they can view that will help us work through these different topics.
I think that would be helpful. So we're going to put, folks, some slides up on the screens here as we talk. You'll be able to see the graphics well, and then Tim and I will discuss those behind. So you're going to see some graphics now. And Tim, go ahead and take us down this path of understanding what risk really is.
Well, Steve, this topic of risk and how to understand risk and how do you deal with risk in one's investment portfolio is one that's debated on Wall Street and in the news media on a regular basis. You covered some major areas that are connected to analyzing and attempting to manage risk in one's portfolio. Let's put this slide on the screen. Here you can see two different lines on this graph, folks, and if I was to ask you the question, which one of these lines looks riskier to you, most people would say the bottom line, because it's going down, and it makes perfect sense.
I've been on the losing side of the equation, and I would certainly say that is the riskier side to me.
And yet academia says that it's really the top line there that's riskier. Why? Because, to use a term that might not make sense to everybody, but it's wigglier, right? It has greater, what we call in our industry, standard deviation. So the standard deviation on the top line is much greater than it is on the bottom line. And so in theory, academic theory tells us that that top line is a riskier investment than the bottom line. And what we see happening is that investment portfolios are put together using something called asset allocation. And here's a typical pie chart of what an average 45-year-old's investment portfolio might be designed like if they were trying to do asset allocation based upon standard deviation. And you can see on this graph here that the large cap growth, large cap blend, large cap value has the largest slices of the pie. And if we were to pull out and just look at internet or U.S. equities slice, the U.S. equities slices of this pie total 89%. And the smallest slices of the pie are going to small cap growth and small cap or mid cap blend.
And these would be consistent with modern portfolio theory developed by Markowitz and all the other geniuses in the 20th century.
Exactly. Academic theory based upon whether it's modern portfolio theory, any number of different that we can put on the screen there would give us an asset allocation model similar to this. And it's largely based upon standard deviation because those large cap slices of the pie are going to have lower standard deviation than the mid cap and the small cap slices of the pie.
So we have asset classes that show more volatility just by the nature of the asset class itself.
Absolutely.
And we talked last week, Treasury bills, a 1-year Treasury obligation of the government's very stable. whereas silver may be highly volatile.
Absolutely.
You're suggesting that large cap growth stocks are maybe less volatile than small cap growth stocks.
Exactly.
So modern portfolio theory says minimize risk, diversify it away through this, and you're taking care of in a home run.
Absolutely.
I wish it were so simple.
Well, let's look at what happened over the decade of from 2000 to the end of the 2000s, 2009, December 31st of 2009, often referred to as the lost decade, because the average investor on the equity slice of their portfolio lost greater than 50% in the not once but twice in two different market declines. If we look at that entire 10-year period, you can see that those large cap growth slices of the pie grossly underperformed or all had negative performance over that 10-year period, and yet small cap and mid cap were the only slices of the equity pieces of the pie that
Tim,
actually delivered positive performance.
Folks, what this slide is showing you, by the way, is truly exploding one of the major myths of Wall Street. What you're suggesting, Tim, by these charts is that by following the geniuses of modern portfolio theory, the investor watching this tonight would have been hurt, and hurt badly.
Absolutely.
The old joke about the 401k becoming a 201k.
This is the reason why. If you were following modern portfolio theory and using merely just standard deviation to build an asset allocation model, which is what all those programs do, it would have given you a very low percentage of your portfolio, a small slice of the pie, if you will, in the only asset classes that actually delivered any kind of performance throughout that decade.
All right, so we stand with a question then. I'm watching the program tonight. I'm hearing what you say. I'm looking at these charts, and I'm shaking my head going, I listen to the Master of Money every week, and I hear what's going on in Europe. I hear what's going on in China. I hear the volatility in the U.S. markets. How do you, as a professional, begin to not have that hurt me? What do you do so special?
Let's take a look at that from the perspective of, Steve, if I was to line up 100 different portfolio managers or financial planners or investment advisors, and I asked them, what are you currently doing to help your clients, to help your investors control downside risk in your portfolio? What do you think that the largest majority of them would likely say, or how would they respond to that question?
You're listening, and if you've watched the program long enough, you're thinking, I diversify it away.
Yes, exactly.
I'm going to follow all of the stuff I've been taught.
So we've been we've been taught not to put all of our eggs in one basket, right? Because
right.
If we drop the basket, then they all break.
That's exactly right.
And so we've been taught, the Kool-Aid that we've been poured is if we diversify, that will really help us in a down market. That we typically will, it's a great way to be able to control risk in a down market.
In fact, I've been taught it's the only way to control risk for the standard person, especially in a 401k.
Absolutely, and that's taught widely in our industry. Let's take a look at this chart here, and this is what the typical diversified portfolio would have looked like, diversified across the various different equity asset classes throughout the bull market run from 2003, after we suffered about a 50% decline from 2000 to 2003, through about the fall of 2007. Here you can see that the correlation spread between the bottom performing asset class and the top performing asset class was nearly 300%. So in other words, diversification actually worked in an up market, in a bull market. Right.
So in a market that the United States had historically throughout the 20th century, the idea of buy and hold, of set it and forget it, could have worked with an upward bias to the markets as it was.
Well, there were certainly periods like this period here when it worked, and there were periods when it didn't work. So let's look at what happened with the following period after this. So we have from 2003 to 2007 that most people in the equity slice of their portfolio, if they stayed in or they got in at the bottom, likely recovered much of the losses that they experienced from 2000 to 2003.
Okay.
And the concept of diversification, not having all of their eggs in one of these asset classes, but diversifying across these major different asset classes, everything from small cap to mid cap to large cap, etc. actually worked for them. But let's take a look at what happened. In this graph here, we can see from the fall of 2007 to the spring of 2009, it doesn't matter how diversified one's investment portfolio was, all of those asset classes went down.
Now, it's been said to me, Tim, that greed is hard to predict, that greed happens at different times. But fear is easy to see because everything comes down. Is that kind of what we're seeing here?
Well, that's partially what happened there, but I mean, it's really just based upon the laws of supply and demand. Or if you have more sellers coming to the table than buyers, it just causes the snowball to roll down the hill.
Folks, I've been in this business a long time, and the worst thing I hear is when guys like this who know what they're doing tell me it's as simple as supply and demand. Is there a more fundamental law that any of us could understand? But tell us a little bit about this chart. I want to put it back up for everybody.
Well, here you can see that over this period of time, whether you look at the best performing asset class or the worst performing asset class, they all went down. Some went down as little as 50-55%, and others went down over 70%. And so really what I'm trying to depict in this slide, Steve, is that it really is a myth that diversification alone will actually help to reduce risk in a down market.
Okay.
And yet that is what is predominantly being sold to us by Wall Street, by the investment community. Most investment advisors, that's what they've been taught, and that's what they teach their clients to do.
Okay, so
Now, I know I'm going to ruffle a lot of feathers with statements like that.
That's what we do here. We're out to explode myths and ruffle feathers if we have to. But you've shown a couple of charts that say this. First, standard deviation may not be a measure of risk at all if your definition is losing money. And secondly, correlation, that often used buzzword on Wall Street, sometimes the only time it really works is in the up market, but on the down markets it compresses and it doesn't give you anything.
Exactly.
So the folks watching tonight are sitting there shaking their heads going, I'm in trouble. I've got a portfolio based on this. I'm in a target date fund. I'm in a 401k. I'm in my own money as a retired person. Tim, you're scaring me. What happens if this happens again? I diversified. Am I going to get hurt again?
Well, obviously, there's got to be a better way, And even Alan Greenspan, as you can see on this slide here, said in March of 2009, I was wrong. So here's, Steve, you're the chief economist here at Harvest. Here's the chief economist of the United States of America. At the bottom of this down market, he basically came out and said that what he had believed in and taught for all these years was wrong. It didn't work.
That's one of the things, Tim, I'm a little bit aggressively outspoken on is the fact that sometimes academic theory doesn't translate into the real world all that well. So let's go through a little bit. Let's move into the world of Harvest and what you do for people and how you can actually take that person's portfolio and put some risk control on it that actually does prevent risk as we would define risk.
Well, Steve, I would be remiss if I didn't go back and touch on one of the topics that you've touched on in previous shows, which has a lot to do with how folks are managing their money or actually having somebody else manage it for them, and that is through the use of target date funds. Target date funds are quite possibly one of the most dangerous tools that has been developed in the last decade. And the reason for that is, we've seen over the 30 years that I've been in this business, a 30-year bull market in the bond market.
Right. And let's put perspective on that. Go back to 1982, 83. We had 15% systemic interest rates. They've fallen down to 0%
Absolutely.
Today.
Steve, when I started in this business back in 1981, prime was at 21%.
Yeah, you remember the misery index?
Absolutely.
I think some of you may remember that. I date myself, but
So where's prime at today?
Oh, what is it? 3,
Right.
2?
And so, often we hear these formulas thrown out. Take your age, subtract it from 100, and that's the portion that you should have in bonds. All right, and often there's these target date funds that have a high allocation in bonds or in cash, and there's a portion in equities.
But we talked last week, John Bogle, the legendary chairman of Vanguard, actually came out and said for every year of your life, you should be that percent in a bond. So if you're out there tonight and you're approaching 65, you're going to be 65% in a fixed income instrument.
And that might have worked fine 30 years ago. All right. So in other words, when these models are developed and they use standard deviation, what they're looking at is the historical movement of those asset classes. And if I look at the last 10 or 20 or even 30 years of performance in the typical bond fund, the returns have been fantastic. But what are the components? What are the two components of total return in a bond fund?
We certainly have talked about interest rates.
Yield and capital appreciation.
Duration in that.
And so as interest rates come down, the value of those underlying bonds goes up, and it adds to the total return in those bond funds.
So fair to say today you have a concern that interest rates could rise in the next some period of time, maybe not tomorrow, but in the next period of time.
Well, Steve, you know me enough that I'm not into predictions and forecasts, so we're not trying to forecast
but
win
I
rates.
am, so
we at Harvest don't try to predict when rates are going to go up. We just know that eventually they will.
We've talked here on the Master Money about Janet Yellen and how they're looking even at this most recent jobs report with the wage inflation they're beginning to see, and that may cause the Fed to raise rates.
Sure.
So your proposition would be to folks watching that if you're in a target date fund and you followed all the right stuff and these rates go up, the bond portion of that fund will then come down.
Right.
Right when you need it the most.
Absolutely. And often target date funds are used by the typical investor that says, I'm really not sure what to do. I'm just going to let them do this for me. Mm-hmm. Right? Because they're not sure how do they build a good asset allocation model, how do they control risk, and so they're trusting that the manufacturer, whether it's an insurance company or a mutual fund that manufactures and creates this target date fund, is going to help them control their downside risk, because they're just going to shift the dial for them as they get older, and their level of risk tolerance goes down because they're closer to needing to take income off of that investment portfolio out of their 401k or their IRA.
Now, I'm not going to let you go on this, though. You've set me up to look at the viewers and say, okay, I get it. The academics may be very wrong this time. And by the way, they've been wrong a number of times. But Tim, I need to go back. What will you tell that person watching us tonight? Here's what I want you to consider as a way to mitigate this risk.
Well, first of all, don't just assume that a target date fund that you're investing in is going to solve all your problems, or even a target risk fund. I would encourage you to go and look at the charts, see what those target date or target risk funds did in the last market decline from the fall of 2007 to the spring of 2009. And you'll see that even though those portfolios were diversified, that they still went down. Secondly, even if equity markets go up, if interest rates continue to go up again, which eventually they will, as we just talked about, that the Fed is currently talking about not if they're going to raise rates, but when. When are they going to do that? And how is that going to affect the bond component of your target date fund? I was just reading a statistic that 64% of the assets in 401k plans is going into target date funds today. So there's a lot of belief and trust being in being entrusted that these target date funds are going to help folks manage downside risk.
Okay, so I want to push you here, and I'm not going to let go, folks. Don't worry about it. If I'm in a target date fund and I'm accepting what Harvest Financial Services says, I should change this. How do you go about making it better for me?
Well, we do believe that there are times it makes sense to be invested in equities, and there are times it makes sense to be in cash, and there's times it does make sense to be in bonds.
I assume you agree with that, because that was about as common sense as it gets. I like common sense solutions, so continue.
So we at Harvest believe in using an actively, tactically managed model that will move us in and out of the market as the technicals of the market dictate that it's time to go to cash or time to go to bonds.
Okay. Little birdie in my ear just said, market timing?
No,
really?
Absolutely not. No, we don't believe in market timing and trying to predict and forecast markets. But we do believe that there are times when the rules of the road say to stop. You know, when you drove here to the office today, Steve, you followed the rules of the road. And which means that when you're driving along, Steve, and you see a red light, what do?
We stop.
You stop. And when it turns green, what do?
Well, we tend to go.
We tend to go. And so that's pretty overly simplistic, but that's basically what we do. There are times when the red light is up, when the railroad crossing is down and it's saying, do not go around this. And really only an idiot says, I'm just going to go and I've got my car in cruise control and I'm going to cruise right through that railroad crossing gate. All right, I can make it around here safely. No, we follow the rules of the road. And Steve, that's what we do with investing. There are rules-based investing strategies that can be used that will help one control downside risk. That when the rules of the road, when the rules of that strategy say move to the sideline, we move it to the sideline until the green light goes back on again and we get back invested in that strategy
One of
again.
the things that draws me to do this is to educate people against myths that are commonly promoted. If you go into the mutual fund world, they will frequently say to these folks, look how badly you'd have done if you missed the 6 best trading days of the year. But what about missing the worst 3 trading days of the decade, or whatever that statement? Point being, what you're doing is getting people out at times it seems to make sense to be out. Not predicting it, not forecasting it, but when, gee, it's screaming sell, why are we still in it?
Yes, Steve, I mean, it's a great point. And our industry, the financial services industry, publishes a lot of marketing material that is really designed for them to collect assets. Particularly the mutual fund industry. And I'm not getting down on the mutual fund industry as a whole, but this is one of those myths that's been created out there that if you miss the 5 or the 10 best trading days that your returns would be cut in half. What they're failing to tell you, as somebody famous out there once said, the rest of the story is if in order to get those 5 and 10 best trading days, you have to be in for the worst trading days. Because typically what happens when we have these major market meltdowns for a day or two in a row, we'll have a rebound where markets will bounce back and give a little bit of that money back. Those biggest rebounds almost always happen just after some of the greatest declines just happened. And so if you can avoid both those huge market decline days as well as those big up days, your returns will be double that of what they would have been if you had just tried to avoid, the 5 best days, or tried to be in for the 5 best days, or stayed invested the whole time and just rode it out. We've got a great white paper on that. If people want to, send you an email, we'd be happy to provide that to them.
Feel free, folks. Write us at questions@safefinancial.org, and we'll get that white paper to them. But tonight, and again, I wish we had all night to talk with you. This stuff obviously is both interesting, informative, and it's actually impactful on you. If you're in one of those circumstances where you've been put into a set it and forget it mindset, please write us at questions@safefinancial.org. And I want to thank you for joining us tonight. Next week, we're going to be back. We're going to have more super stock information for you. But for tonight, I want to thank our sponsors, Harvest Investment Services, where they do, in fact, harvest gains and minimize losses. Superstock Investor, and our musical prodigies who provide the music, Ron Blake of Ron Blake Music and Chris Yantz. I want to thank everyone who's involved in the Master of Money, and I look forward to seeing you next week for another edition of the Master of Money.